These are the 7 investing mistakes that will fuck your portfolio. I've been investing for over 8 years now, and I've built my portfolio to over $1 million. During this time, I've seen my students make dozens of common mistakes, and by correcting these mistakes, I was able to easily add 10 to 15% to their portfolios. The first mistake, and the one that destroys most people's accounts and financial future, is leverage trading. Leverage trading can be options trading or using margin, in which people borrow money from the brokerage to purchase stocks. The reason you want to stay away from this is because this can lead to magnified losses that will affect your emotions, paying money on the interest that you owe the brokerage, and even selling some of your positions at a low price when you should be buying into a position. I mean, look at Wall Street Bets. You see everyone that trade options or does leverage trading. They end up losing all their life savings, their homes, and much more. Those horror stories are happening every day to people. And it's a mistake that I had to learn the hard way after I lost over $100,000. I ended up buying a short-dated option contract, lost a lot of money, and then compounded my losses over and over again, chasing those losses. There's a reason that there's a statistic that 95% of day traders are unsuccessful, and it's for good reason. Yet most people still do it because they are chasing quick money. So here's what to do instead. Don't leverage trade or do any sort of options trading. Turn off leverage trading on Robinhood or your options buying account on Robinhood. Focus on buying equities or securities that are undervalued. By doing this, you mitigate your risk by a lot. After you've found an undervalued stock, go into a charting tool like TradingView and mark your buy zones through support and demand zones. Then use the Fibonacci retracement tool. This allows you to know when to buy and when to sell a stock, allowing you to put yourself in the best position to minimize your risk and maximize your profit. The second mistake is not having a trading plan. Most people are throwing spaghetti at the wall and hoping it sticks. They don't have a clear entry or exit point, meaning they don't know when to buy or when to sell. They think because their friend tells them to buy a stock, they should blindly buy it. They also don't have any risk management rules, which is why most people end up losing all of their money. The reality is, if you enter into trades without a clear plan, you will get inconsistent results. Let's say you hear about a new tech company that's getting a lot of buzz. Their stock has been rising steadily for the past week, and you see on the news how it's the next big thing, and you hear some of your friends making crazy gains with it. So without doing much research or setting any specific goals, you decide to buy shares immediately because you don't want to miss out. And now the scenario can go one of two ways. You can get lucky and make some money, or the stock drops and you lose all of your money. It's a complete coin flip. You don't have an enter or exit strategy. You didn't do any fundamental analysis. You didn't have a clear profit level. You're gambling your own hard-earned money. So let's not do that. This is what I do before I enter a trade. For me, I take an approach of researching my stocks and understanding both the strengths and the weaknesses of the company. What is good about this company? Why is this company performing poorly? Is there a catalyst in the future that will spark growth and change in trajectory of the company? This will give you an overview of whether the company has potential for growth and can skyrocket in the future. After I've done my fundamental analysis, I then hop into the charting platform. You can use TradingView. I want to mark my buy zones through support and demand zones. A support zone or area is like an invisible floor for the price. When the floor drops, it often stops falling at a floor where the price will accumulate before it bounces back up. In trading, if the price drops a lot, it might go through a support zone, but most of the time the support zone catches the price and stops it from falling further, just like how the floor usually stops your ball from going down more. Then there's the demand zone, and let me give you an example. Imagine you have a lemonade stand in your neighborhood. You sell lemonade for $1 a cup, but sometimes you have a special deal where you sell it for 50 cents. The demand zone is like the price where your neighbors get really excited and want to buy your lemonade. When your lemonade is $1, some people may buy it, but when you lower the price to 50 cents, suddenly everyone wants to buy it. The 50-cent price is like the demand zone. In trading, when the price of something, like a company's stock, gets down to that demand zone, lots of people want to buy it. It often sells quickly. The price usually stops going down and starts going back up. Just like how you know your lemonade will sell fast at 50 cents, traders try to figure out these special prices, the demand zones, where lots of people will want to buy, because that's often where prices stop falling and start rising again. The next part is to use Fibonacci retracement. This is a tool that allows you to identify buying and selling areas. So to plot out your Fibonacci retracement, you want to identify a trend. For us, it's going to be an uptrend. From the uptrend, you want to mark out the swing low, which is the absolute bottom, and the swing high, which is the absolute top. From then, you'd get your Fibonacci retracements. I want to buy at the golden zone, which is roughly around the 50 to 61.8% retracement. If I do these all properly, I will know exactly where to buy and sell. The next mistake I'm going to talk about is the one most people will run into, but is the easiest to overcome. It is letting your emotions control your trading decisions. This can be a result of a lack of a clear plan. If you don't have a clear plan, it is is common that your emotions will take over and start to make your decisions for you. This mainly affects many newer investors or traders because everyone wants fast money. There's another 99% that are losing money. That is what the gurus will try to sell you on. Quick money. Quick money means you also lose that money fast. You need to adopt a long-term perspective if you want to come out on top of the stock market. You'll end up buying and selling out of positions and you'll just be an unorganized wreck. And the more positions you're in, the more you're at risk of losing more money. It's just a simple probability. If you do 100 trades, you're at risk of losing at 100 of these trades. I remember when I started trading, and as soon as my position went red, I would get flustered and find a way out of my position and eventually sell out my position, only to find out 1 hour or a day or two later, my position would have ended up profitable. Had I controlled my emotions and not let fear and panic sink in, I would have been up a sizable amount. That's how the market will manipulate you. And it's the reasons you need to control your emotions. The best way to deal with emotions is by having that clear plan and edge over the stock market and approach it with a long-term mindset. If you have a long-term mindset, the short-term volatility won't faze you at all because you know that the stock will eventually go up. The fourth mistake, and the one that most people have a hard time getting is, but the best skill to have, is the lack of patience. We live in a world of instant gratification. I mean, look at Amazon. We're able to get packages the next day, if not the same day. What you need to understand about investing in the stock market is that it's not a get-rich-quick scheme. You need to go into the stock market with a long-term perspective in mind. Yes, you see people making lots of money very quickly, but what you don't see is the other 99% of people that are losing all of their money. Warren Buffett explains that the stock market is a device for transferring money from the impatient to the patient. The real money investing is made by buying wonderful companies at fair prices and holding them for years, even decades. It's like owning a farm and watching the crops grow season after season. So before you try to chase another get-rich-quick stock and be impatient, do this instead. Ignore the short-term noise. Have conviction in your stocks. Focus on the value, not the price of the stock. And don't constantly check your investments. Remember, no one ever got poor taking a profit, but many have gone broke trying to get rich quickly. The market rewards those who can sit still in a room alone, letting their investments compound over time. The fifth mistake, and perhaps the one you can fix right away to get crazy results, it is not keeping a trading journal. And for some reason, most people don't have a trading journal. It's because most people think it's too much work. Yet this little amount of extra work can be the difference between you becoming a great investor versus a mediocre investor. A trading journal is like a diary for your trading. The idea is that by writing all of this down, you can look back later and learn from what you did. If you don't learn from your mistakes, you will never improve and get better. This will allow you to make better decisions in the future, and if you make better decisions, you will make more money. When you don't document your trades, it makes it really difficult to track down your past mistakes or recognize what successful patterns you got into. There's a saying that says, what gets measured gets improved, and that's a philosophy that I've stuck with. Don't be a smartass and think that you're too good for a trading journal. Here's what I recommend you do for your trading journal. You don't have to get an app to do it. You can simply use a Google Sheets. Track the date of every trade you make. Track the entry points. Track the exit points. Track your trade rationale. And after every trade, put in the notes section of your current and post-trade analysis. I like to track what is currently going on as I'm in the position. That allows me to figure out what is currently happening. And then after I close out the position, I'll write some detailed points of why that trade did bad or good. The next mistake, and the one that prevents people from even trading, is trying to time the market. The reality is that the stock market is unpredictable. The market's reaction to news combined with its volatility make timing nearly impossible. You cannot predict short-term movements, at least reliably. That's why it's so important to have a long-term vision to combat market timing. Take a page out of Warren Buffett's book. He mentioned that to stop trying to force timing the market and instead focus on long-term value. Here's what to do instead of trying to time the market. Dollar cost average. This basically means you're able to minimize the risk of investing a large sum at the wrong time while giving you a better average. Let's say you have $10,000 to invest and I'm looking at a stock that is currently $70. If I were to dollar cost average, I would invest 40% of the $10,000 at $70. Then if the stock were to drop to $65, I would invest another 20% of the $10,000. Then if the stock were to drop again to $62, I would invest the next 20%. This allows you to worry less about market fluctuations and having any perfect entry points, but ultimately lowering your risk and giving you more profit on the upside. The last mistake, and the one I may get a lot of hate for with all these financial gurus, is do not focus on diversifying your account. If you are starting out with a limited amount of capital, there's no point of diversification. Diversification can dilute your returns. Most people think diversification helps with risk risk, but it's because of not understanding your investment. Warren Buffett drills this point forward even more when he talks about that if you want to make any real money from the stock market, avoid diversification. But if you want to be just an average investor, go for it. Here's what to do instead if you want to avoid diversification. Focus on investing in undervalued stocks. Be patient and wait for the right opportunities. And only invest in what you deeply understand. Holding 1 to 2 undervalued stocks will make you more money than a low-cost index fund. Imagine you held NVIDIA for the last 10 years versus the S&P 500. Who would be up more? And that is 7 investing mistakes that will mess up your portfolio. Apart from knowing mistakes to avoid, we also want to know how to actually trade. That's why I decided to compile my 8 years of investing experience into this full course so that you can learn all this to know about investing. Click here to watch it, and I'll see you in the next one.